Today, I'm going over everything you need to know about the recent bank failures with Silicon Valley Bank, along with Silvergate, going over the recent failures, the next potential bank failures, government intervention with Janet Yellen recently meeting with Meet the Press, along with what to do as a U.S. citizen or an international citizen when it comes to protecting your wealth. Going over a lot of different things, both sides of the arguments. I'll have timestamps down below in the description so you can skip ahead or back depending, along with links to everything we cover. So really, it's kind of two sides of the argument right now. We're seeing a lot of these venture capital investors where a lot of their portfolio companies were involved with Silicon Valley Bank, typically with a lot more money in the bank than the $250,000 US, which is FDIC insured. So going over everything again, I'll be breaking it all down kind of an easier to understand way, giving you the context here in a second. But that's really kind of the two sides here is the venture capital investors. And then there's the other people that are basically saying, hey, no bailout, let things fail. This needs to happen. Not a bad argument. I mean, when it comes to hedging, especially if Silicon Valley Bank, just if you looked at the Q4 report just of last year, you can kind of see that they really didn't have much hedge risk against some interest rates. So something that's very, very important is hedging your risk on interest rates when you're buying mortgage-backed securities as a bank. Super, super important. So basically, let's go into this, and then we'll go into these articles, break down everything you need to know, along with some recent stuff. I'm recording this on Sunday, March 12th at 3:07 p.m. So there will be a lot of different changes. We'll see. It's going to be a lot of exciting things here come Monday. And before we get started with this, I think just a quote to keep in mind that's very, very interesting. I think Lenin said it, which is there's decades where nothing happens, and then there's weeks when decades happen. And we're definitely in the environments where there's weeks where decades are happening. This is kind of the unraveling of the U.S. banking system. I mean, a lot of people don't even understand the very basic concept of the U.S. banking system, going from full reserve to fractional reserve. Basically, most banks only keep less than 10% of your actual deposit in the bank and loan out the rest. In the case of Silicon Valley Bank, a little bit different because it is involved in early stage tech startups. But just to give a little bit of context, since this was the second largest bank in failure in U.S. history, let's go over the first and the third. So really the first largest was Washington Mutual in 2008. At that time, it was $307 billion, so about $100 billion less than this. And then the third largest, which is significantly less, is the Continental Illinois National Bank and Trust in 1984 with only $40 billion of assets at the failure. So what exactly caused this for Silicon Valley Bank? Then we'll get into everything else. So again, I'll have timestamps for everything so you can skip back and ahead. And again, leave me comments if you guys have questions, anything like that. I'll be covering this a lot more, a lot quickly. I've been working on a lot of international investment projects and a lot of business things as well. So very interesting to cover this topic. But again, let me know in the comments if you have any questions throughout this video. If you need help with anything, just let me know. So over the past 3 years, deposits in Silicon Valley Bank went from $60 billion to $200 billion. This was kind of in the easy environments with COVID, with a lot of stimulus. There's a lot of kind of free capital moving around. It was very easy to fund early stage tech startups. And this deposit surplus basically led them to enter the bond market in order to buy up treasuries in a low interest rate environment, which was about $80 billion in mortgage-backed securities. Interest rates rose from 0.25% to 4.75%, pretty insane. And if you understand how bonds work, basically it's the inverse relationship to interest rates. So as interest rates rise, so it went from 0.25% to that almost 5%. As those rise, then the actual bonds decrease in value. Now, if you can actually hold them to maturity, these bonds, it's completely fine. You don't take a loss. But the issue is in this situation, a lot of, with the global economy kind of lowering, harder environment to be in, a lot of these tech startups, a lot of these companies in the tech space, in the crypto space, went and kind of called for cash from the bank, causing Silicon Valley Bank basically to have to sell these early, basically taking a loss. This basically the value of their long-term bonds have dropped over the past year, while the economy has slowed with the major sell-offs in the tech sector. Customers needed to withdraw cash, forcing SLV to sell treasuries at a loss. So that's kind of one of the things that causes insolvency. And then as far as Silvergate goes, so crypto, obviously fared even worse with FTX, with Celsius, all this craziness in the crypto space, which is kind of what you're getting. I still am very bullish on the crypto space. It's actually done pretty well today since this has happened. Crypto pumped a decent amount, especially if we go here to BTC. Let's take a look at this real quick. So yeah, just on the day, it's very interesting, popped up quite a bit. I think Bitcoin, I'll get to that a bit more later, but it'll do very well over the long run. Then Silvergate announced the results for Q4 2022, showing a $1 billion loss. More customers tried to withdraw their funds, causing the recent failure. So we'll move into some of these articles, some of the things from David Sachs, which is a guy from the All In podcast. A lot of people are not very happy with at the moment, but he has an interesting argument. I think I can see it from his perspective. So just going over this really quick, a little bit more detail in SLV. Obviously, USDC dropped below the peg of $1. This was kind of another consequence of this because USDC Circle has a lot of their assets with Silicon Valley Bank. And, there's a lot of ripple effects, contagion effects from this because tech startups provide a lot of the APIs for banking. And this can kind of hit a lot of other sectors beyond just the US, VC space. So let's see here. So around $211 billion in assets. Mark to market, they were insolvent, like I said. So when you have to sell a lot of these mortgage-backed securities, a lot of these bonds, basically you're going at a loss. People kind of realize this. A lot of people were shorting it. $43 billion cash was drawn in one day, pretty insane. Then 50%, they basically provided around 50% of banking coverage for the Silicon Valley startups. And obviously, the startups are linked to a lot of the people in the global economy and a lot of the other businesses in the global economy as well, providing them kind of like fintech-based solutions. Insiders. So a few weeks before this, the CEO sold, I think around, 3.57 million. So 11% of the shares. Interesting to see. I think the CFO sold a decent amount as well. I don't think close to 1 million, but I know in the hundreds of thousands at least. Then quarter four earnings statement showed, they were closer to insolvency in December. So it was kind of on a lot of these short lists and would have been a very nice short. So went over USDC. And then the second order effects, just wanted to cover this real quick. So USD Circle, we talked about that. Obviously regional banks, so we could see a lot of runs on them this coming week. It'll be interesting to see just because, these are not really the top tier banks. So a lot of people will either try and withdraw their cash, or most likely what most people will do, especially with large sums of money, just wire it from one of these kind of lower tier banks to a tier A bank, so like a JP Morgan Chase. So it'll be interesting to see what happens with that. I also think it's going to be very, very hard for most big tech employees and a lot of U.S. citizens that only have their money in the bank. They're not diversified across asset classes, which is one of the things we talk a lot about on this channel. International diversification, political diversification, getting into alternative asset classes. I'll get to that a bit more later. Let's cover the rest of these, potential next failures. Not too much here, but it could be interesting. I know Republic Bank is definitely one of them. So if it goes into receivership, the FDIC could be the bailout mechanism, and then contagion. The Silicon Valley companies provide vital infrastructure to businesses, both in the U.S. and internationally. Okay, so these are kind of the two sides of the argument. So the VCs want to bail out, and I'll get to this here in a second. So David Sachs basically coming in, talking about Janet Yellen. And then this, actually, I really, really liked this article. Very, very interesting. Alfonso, he runs the Macro Compass, and this is very, very fascinating. I'll get to this here in a minute, but let's run back here. Basically, the VCs want to bail out depositors for a shareholder. Like I talked about, Yellen already said, there won't be a bailout for shareholders, which there shouldn't be, obviously. So those are people that actually invested in the company. They will not receive relief. Depositors may receive relief, but supplemental, right? So maybe it's like 50% is what Bill Ackman was kind of speculating, but potentially it could be a bit more depending on what Yellen and the Fed decides to do. So if no bailout, the dominoes may fall and spread more fear. If bailout, Silicon Valley Bank would have to sell off around $80 billion in mortgage-backed securities, and this can have really second-order consequences and ripple effects across the global economy. What to do as far as this, then we'll get to the other things. My personal opinion, precious metals, gold and silver, crypto, really just Bitcoin in my opinion, and make sure it's not held on an exchange in a cold wallet. We saw this I've constantly been preaching this on the channel, is you want to hold your Bitcoin in cold storage. I personally see it as a very long-term investment, just like gold and silver. You want to have the physical bullion either in a vault that you trust. There's some great places to do that. Or just, physically holding it somewhere that you can keep it safe. You don't want it to, it's speculation to invest in like mining companies, for example, so like gold or silver, junior or major miners. But, I've been talking about that for quite a while on the channel. I can discuss this more moving forward. And then when it comes to political diversification, there's a lot here. So land, real estate, foreign banks, mobility assets. Those are things like passports, residencies, visas, and then alternative asset classes. So, strategic metals invest. They sell rare earth metals, so things that are very, very important. Electric vehicle batteries and a bunch of different things. Art, watches, those are all different decent alternative asset classes. So moving on. Okay, so this article, they talk about the death of Silicon Valley. I find this very, very interesting here. He goes on to talk about saying that 3 months ago, Silicon Valley Bank was the 16th largest commercial bank in the U.S. Today, it no longer exists. On March 8th, Silvergate, the smaller bank, realized in the crypto business, announced that it would be voluntarily liquidating in the wake of large losses, rapid customer withdrawals, a Department of Justice probe, and a worsening crypto market. That same day, Silicon Valley Bank announced that it had sold significant amounts of U.S. treasuries and agency mortgage-backed securities at a $1.8 billion loss and would be raising more than $2.25 billion in capital to strengthen the balance sheets. Basically, they ended up going to insolvency. So this is a very, very interesting chart. So these are all the unsecured deposits. These are the actual FDIC secured deposits of Silicon Valley Bank before the run. This is really just insane. So a lot of these charts I'll run over in this article. So Silicon Valley Bank before the run. So this is the insured deposits percentage of total assets. And then insured deposits percentage of total deposits. So total assets versus deposits. Obviously, deposits were lower than the assets. Silicon Valley Bank before the run. So this is their long-term assets with 5+ years. So that really popped up. So let's see, Silicon Valley before the run. Yep. So held the maturity of securities available for sale securities and all other assets. So interesting to look at there. And Alfonso's going to go into this a little bit more when I go over to his article, but pretty interesting to watch here. Again, I'll have the links to all these articles down below in the description so you can review everything there. Very, very fascinating to see this. Lots of, in my personal opinion, I agree with him more than David Sachs. The issue with David Sachs is he's more asking for bailouts. I mean, obviously he's very, very involved. I agree to prevent contagion, prevent bank runs. It's very important to do. But basically he's saying that the formula here was correct. No bailout for the stockholders. We already went over that. They will meet the needs for depositors and prevent contagion. But it was very, very vague. And he basically what he's saying is that no bailout for the SVB stockholders and bondholders, but deposits are safe, not just for them, but all regional banks. You can trust the U.S. banking system. Now, very, very interesting. That's a much longer term argument. I wouldn't necessarily go into that. I think eventually that will happen. It just depends when, not if. That's at the end of the day. It's very, very important to understand. At one point in time, there will be a run on all these banks, and people will have to understand how the banking system actually works, something I've been talking about, again, a lot on this channel for a long time. And basically, he's saying that they also should have said that they will backstop if it is necessary to prevent contagion, and that they will defend the U.S. banking system. Okay, so moving on here to Alfonso's, I think this is really my favorite article out of all of them. So Silicon Valley Bank went belly up in about 30 hours, and it is not the Federal Reserve's fault for raising their interest rates. It's a result of very concentrated funding base, embarrassingly bad market risk management, and a ton of moral hazard at play. Interesting. This piece will basically attempt to answer the questions that all of us have been asking. What exactly went wrong for a $200 billion balance sheet bank to go down so fast? How serious are the spillover risks? Is the entire U.S. banking system in trouble? How will the Fed and the markets react? So disastrous risk management, very interesting. So essentially what he goes over here is when they're buying all these mortgage-backed securities, which is kind of a bit more of a complicated topic. I'm not going to go into super detail, but basically when you're a bank, you basically have to look at what you can buy as an asset. So assets and liabilities on the balance sheet. So, a depositor is actually a liability. So like if I'm giving you $100 at the bank, that is technically a liability for them on their balance sheets. They have to back that up with an asset, right? That's the idea. They're only going to hold about 10% of the liability there, and they're going to loan out the rest. They're going to make the spread. Basically, they get the interest rate off whatever, they get the interest off whatever they invest in. So, if they're giving Susie a house for $200,000 and the interest rate is whatever, they get that. And they give you, the depositor, like a smaller percentage of that, usually less than 1% in the US. So, after the great financial crash, after the last financial crisis, basically the amount of high quality liquid assets, at least big enough to meet stress outflow deposits for 30 days, and liquid coverage ratio above 100%. And this basically, he goes into what basically qualifies as that. Essentially, what this all comes down to is the interest rate risk that, again, I talked about that they didn't exactly cover. They didn't really hedge against. When you buy treasuries, you lock in a fixed yield and you receive rising interest rates that represent a risk. To hedge that risk, you enter into an interest rate swap. This time you pay away a fixed yield and receive the variable payments in exchange. So basically, when you're receiving this in exchange, what you want to do is have something to hedge the risk there. And basically, they didn't have any of that. So that's like a massive, massive thing. So they did not hedge interest rate risk at all. The duration of their huge portfolio before and after was the same. There was no hedges, which is kind of ridiculous, especially for a bank like that. That's when they talk about the moral hazard. So outrageous use of accounting tricks, not hedging, just ignorance, and not necessarily. And then the urge to stay away from the tighter regular scrutiny. So very interesting here. And he wraps up with, what's wrong with that? Well, Silicon Valley Bank isn't the only bank with assets over $250 billion benefiting from that. But it would help to know that Silicon Valley Bank's management repeatedly lobbied to increase their cap of lax regulatory scrutiny and conveniently remains 20 to 30 billion below the $250 billion threshold. It is hard to deny the decent amount of moral hazard at play here. So should the government fully bail SVB out, or only make uninsured depositors whole. Obviously, they're not going to fully bail SBV out. They're going to try and make depositors whole, or at least partially whole, supplementary. And then is it the canary in the coal mine for the systemic banking crisis? Very, very interesting questions to ask. Let me know in the comments your questions, your thoughts about this. Very, very fascinating. I highly recommend this article. Again, I'll have it linked down below in the description. Then a few zero hedge articles. So this one's kind of interesting, talking about basically that this is never seen before, that this, bank runs Friday morning, this is a great scene from It's a Wonderful Life. I absolutely love that. When he goes like, your money's in Susie's house, your money's in Bob's house. They're basically showing us like bank runs here, people basically lining up for their money, all at Silicon Valley banks. Now, I would be very, very careful of fear, uncertainty, and doubts in this. Obviously, I mean, there are going to be people lining up, but it's, especially with AI, with all this stuff you can do now in the media, it'll be very, very interesting to see exactly what happens, because there will probably be a lot of fake information that goes out there. I'll also cover this article in the description as well, so I'll have links to all of this, but very, very fascinating. Very fascinating. It'll be interesting to see what exactly happens on Monday, so I'll definitely be covering this again and doing a follow-up video. That's pretty much all for this video. If you guys have any questions, any comments, let me know. If you have any topics you want me to cover moving forward, let me know. But that's all pretty much for this one. Kind of all over the place, but just wanted to cover this. And I'll be adding to this mind map here as we go on. And yeah, thank you very much for watching. If you enjoyed the video, like the video, subscribe to the channel to stay up to date. If you don't agree with me, let me know in the comments. If you dislike it, dislike it. If you like it, like it. That's all for this one. Invest global, and until next time.